Hey, today we'll be looking at another company I'm very interested in. Full disclosure, I already have a position in this company and have held a position for a few months now. I got in around at $2.90. It's already run about 50%, but I think there's substantial upside to this company, and we're going to cover that in this video. So the company today we're looking at is Transocean, with the ticker symbol RIG. Again, this is another offshore oil services play. This is a company that specializes in rigs. They have a substantial fleet that is capable of drilling in harsh environments. As we mentioned in previous videos, the macro outlook for the sector is highly attractive. Hydrocarbons will remain the primary source of energy for the foreseeable future, and some of the largest reserves of hydrocarbonates are now in the offshore in deep water harsh environments, which requires these specialized rigs and technologies to harness that resource. So I feel Transocean is perfectly placed to capture this uptick in demand for offshore drilling with its specialized fleet of floaters and drilling rigs. So let's firstly just cover the elephant in the room with this stock, and that is the very high level of debt. As we can see, it holds about 7 billion in debt, and this is one of the reasons the share price has been kept low, because I think a lot of investors are worried about how will they service their debt. And if we look at its competitors in the market, its peers, out of all of them, it does have the highest debt. Given the balance sheet woes, there is a lot of volatility in this stock and a very high considerable amount of risk. But given the macro outlook of the industry and the following points we will cover, I'm still very bullish on this stock, and for me it's always about risk to reward. I think the reward is substantial in this stock, where the risk of course is 100% loss, which I'm willing to accept. The management team is very seasoned and experienced at RIG with the average tenure of 7 years, and this 7 years was in one of the worst downturns of the industry. So they did endure a 7-year industry downturn that saw all of its competitors enter bankruptcies. So for me, the management team has proven that it can navigate the debt, and it's proven adapt at managing the liquidity problems of this company. So recently we're seeing quite an uptick in insider buying of this stock, which is always great to see. That basically shows confidence in people that are actually in the crooks and nannies of this company are starting to really feel positive about the outlook. So if someone who has more information than me and you is already putting money where their mouth is, that is a very bullish sign. Given its high level of debt, how does Transocean plan to actually pay that debt off? Well, one real positive for this company is the backlog. So this company has the highest backlog of any of its peers in the industry. As you can see, it is around 6 billion of backlog. That's basically future cash flow for this company that can be used to service its debt. And it's just getting better and better for Transocean. They're signing multiple new contracts at higher day rates. And given the lack of supply and the increased demand, we can really see day rates really exceeding the highs of the previous cycle. Given inflation as well, this is kind of a no-brainer that day rates will exceed the previous highs, which just goes all the way to the bottom line of this company, improving its future cash flows and thus increasing the valuation of this company. Based on its peers, the price to sale value for RIG is looking very good. Price to sales ratio is basically calculated by taking a company's market capitalization and divided by the company's total sales or revenues over the past 12 months. So we can see by this chart that RIG is actually very undervalued based on its price to sale ratios compared to its peers. Even more impressive is the price to book ratio of this company. So what that basically means is that, let's say it was to sell all of its assets, it would still be able to service its 7 billion debt, at the same time still paying out shareholders more than the current value of the share price that it is today, indicating how valuable these assets are, and secondly how cheap also we are getting these assets for at the current stock price. The market consensus is that this stock is undervalued around 61% with a fair value of around $11 US. So there is still substantial upside to the stock. As mentioned, this is not investment advice. I do have a position in this stock. and as mentioned, my cost average is $2.90. Yeah, I hope you enjoyed that video. Please give me a like and subscribe as well for future videos.